Did you buy in Bitcoin over the weekend?
I didn't use Bitcoin, but I spent a lot of time visiting stores.
And
it was interesting. I saw a lot of traffic. You know, this was a very robust weekend. Black Friday remains the marquee event in retail. And of course, Cyber Monday, the key event in cyber retail. We saw a huge increase in internet sales across retailers over the weekend. No doubt about that. That was expected. I think what wasn't as much expected, maybe a bigger story, is that the bricks and mortar were pretty resilient. There were a lot of people who came out. If there was a decrease at bricks and mortar retailers, it wasn't at all of them. Some went up, some went down. And by and large, there were a lot of people in the stores. When you add that together with the huge growth, the double-digit growth online, you saw a big increase in spending on Black Friday.
But is it enough? So take a look at this chart in my Bloomberg here. This is just for the S&P Retail Index, looking at their debt outstanding, $222 billion. That red line is the average. We are well above that. And my question over the weekend, as the foot traffic picked up, as e-commerce picked up, is it enough to offset the massive amount of debt that's coming due in this industry?
Well, it's much more complicated than one weekend's results.
To be sure.
And what you are seeing is Black Friday is holding up, and it's been holding up for a couple of years. So people are coming out, they're enjoying it, they're shopping for the bargains. But retail faces a very transformational period right now. Certainly an underlying cause is the growth of the internet and the shift online. What's happening in bricks and mortar stores is, of course, they're losing some of that business. They're getting some of it back through their own growth online. So you see huge growth at sites like Macy's.com or Nordstrom.com or all of the others. But unfortunately, that comes at a much lower profit rate. So there's a negative arbitrage. So even if the sales hold up and these traditional retailers retain market share, their profitability declines because frankly, nobody makes money, very few, on selling goods online and shipping them to people's houses.
Jerry, you've had an incredible career in US retail. I do want to talk about Toys R Us and your experience there. It has not been a good year for anyone involved in Toys R Us now or who have been involved with Toys R Us previously. Are there any lessons as you look back on things with Toys R Us, and is there a lesson that some of these retailers now need to be applying?
Again, I would never second guess the current management. I haven't gone there for 5 years. It's a very leveraged situation, as many of these situations have become. I think you've seen that private equity, by and large, is now shunning retail as an investment because it used to look like a place with tremendous cash flow generation, and now it looks like a place that requires huge investment in order to win the ongoing battle that's taking place there. The other thing that's gone on there is just the huge growth of Amazon. Whereas if you go back 5 years, Amazon had 4 or 5% of the toy market. Today, they have 4 times that much. I don't know the exact number, maybe 16 to 18% of the toy market. So they came out of nowhere. They had to take that share from somewhere. They took some of it from Target, some of it from Toys R Us, some of it from elsewhere. But inevitably, that stressed the market.